Let's look at two people. They are the exact same age, make the exact same salary, and both manage to save $50,000 in cash. The first person takes that 50 grand and uses it as a 20% down payment on a house. They sign a 30-year mortgage, take the keys, and start building equity. The second person decides to keep renting. Instead of a down payment, they drop their entire $50,000 into a total stock market index fund and set up automatic monthly contributions. At dinner parties, the homeowner is congratulated for acting like an adult. The renter usually gets polite nods and a little pity, because everyone assumes they are just paying their landlord's mortgage. That common reaction is based on a mathematical illusion. The assumptions we make about real estate often leave people house rich and cash poor, while disciplined renters quietly build massive liquid wealth. This isn't a simple equation of which asset prints more money in a vacuum. We need to expose the unrecoverable costs and the invisible risks hiding inside both the real estate and the stock market paths. We are conditioned to believe that rent is throwing money away, but buying a house requires throwing money away too. A monthly rent check is just highly visible. Home ownership costs are a slow bleed that go in directions you rarely notice, like front-loaded mortgage interest and property taxes. The winner in this debate isn't universal. It depends entirely on how the specific friction of an asset aligns with how you actually want to live your life. The main reason real estate creates millionaires is your ability to use the bank's money. When you put $50,000 down on a $250,000 house, you control the entire asset. But that leverage comes with an immediate penalty. You've locked your net worth into a highly illiquid asset, bolted to a single zip code. Then there is the cost to keep that asset running. Financial planners use the 5% rule to measure the unrecoverable cost of occupying a property. Roughly speaking, every year you lose about 1% of the home's value to property taxes, 1% to maintenance and repairs, and about 3% to the cost of capital, mostly the massive amount of interest you pay the bank over 30 years. You can save money by doing the property management yourself, but fixing a plumbing emergency at 2 in the morning or dealing with tenant turnover turns your investment into a stressful, unpaid part-time job. Real estate is a highly leveraged, time-intensive business operation. On the other side, the stock market builds wealth through uninterrupted compound growth. It requires exactly 0 hours of your time. You set up an automatic monthly transfer to your index funds, and you never have to think about it again. The major structural disadvantage here is the lack of leverage. Your $50,000 only buys $50,000 worth of assets. But in exchange for giving up leverage, you get total freedom. If you get a job offer across the country, you can pack up and move in 30 days. If you need cash, you can sell your shares with a tap on your phone. Stocks give you absolute mobility and zero physical labor. But because you are only using your own money, the absolute wealth generation starts off much slower than it would with a mortgage. Succeeding in the stock market requires a specific type of endurance. The ability to watch your net worth drop by a third in 1 month without flinching. This chart shows the S&P 500 around March 2020. In a single month, the market plummeted 34%, testing an investor's resolve. During drops like this, retail investors panic and sell, locking in their losses exactly when the market is about to recover. And if you choose the renter's path, you must actually invest the difference between your rent and what a mortgage would cost. If you rent and spend surplus cash on takeout and car payments, the math falls apart. The stock market outsources the physical labor of property maintenance, but it transfers all the risk onto your own emotional discipline. Neither of these asset classes is universally superior. They simply demand different sacrifices from you. Real estate costs your time and liquidity. Stocks cost you leverage and demand extreme psychological discipline. Filter these vehicles through a decision matrix, starting with one question. Will you live in this city for at least 7 years? If not, the transaction fees of buying a house mathematically guarantee you lose money compared to renting. Forcing the wrong asset into your lifestyle guarantees financial friction, regardless of historical spreadsheet returns. Mobility-first professionals who value geographical freedom and the ability to move for a promotion gain the most from the index fund approach. Keep renting, put your down payment into index funds, and let compound interest build your liquid wealth while you maintain your freedom. If you are an active optimizer, someone willing to treat property management as a dedicated part-time business, your path is different. Buy property. Use house hacking to lower your living costs. The leverage and tax shelters available to an active operator mathematically outpace passive stocks. Finally, if you are a rooted family looking to customize a permanent home to live in for decades, you should buy the house. Just treat that primary residence as a lifestyle consumption choice. It is a place to live, not a guaranteed standalone retirement plan. Your true wealth should still be built in income-producing assets. Choosing either path based on societal pressure without auditing your own life turns a wealth-building vehicle into a financial trap.